Welcome back. Italy's borrowing costs are now at the highest level that they have been since that country joined the Eurozone. That means that debt is not only crushing, it's getting harder to finance, and there's pressure building on the government and on the economy in Italy. It's the same situation that led Greece, that led Ireland, that led Portugal to having to go and ask for emergency bailout funds. So it's raised a lot of speculation as to what's next for Prime Minister Berlusconi's government. With us now is Dean Curnutt. He's the founder and CEO of Macro Risk Advisors. You must be busy these days, Dean.
Yes, we are.
But tell me, when you look at Italy, what is the borrowing cost that makes you extremely nervous? Is there a certain yield?
Sure, I think it's below where it is now, unfortunately.
Really?
I think the yields are problematic for two standpoints. The first is the concept of contagion. And contagion is one where there's a black hole, where investors just run for the hills. And I think, unfortunately, the politics of Italy right now, with Berlusconi not having any credibility, and just the overall strains in the Eurozone are, contributing to an environment where contagion is rampant. But the second and longer-term problem is that borrowing costs retard growth. And with borrowing rates up here so high, it's going to be very hard for them to grow their way out of this problem.
Well, the perception here on the floor when you talk to traders is that anyone other than Berlusconi coming in there is going to be a so-called yes man, that things are going to get done, that they were going to have to do whatever the EU asks them to do. If Berlusconi steps down, is that a positive? It
would seem to be a positive. I think he's certainly impacting things for the negative at this point. I don't know much about the politics of Italy. I would say, though, that the challenges of getting out of this, what we would call a debt trap, where the costs of borrowing are so high, those are formidable for anybody. And I think with the limited policy weapons in the hands of the Eurozone policymakers, as well as the limited role that the ECB seems willing to play, it makes the situation more challenging.
How do you protect yourself against this kind of risk?
Yeah, the first thing I would say is cash is king. And, there's a lot of optionality in cash, meaning you can, just by virtue of not being fully invested, you have the opportunity to sit and watch.
Just literally sitting in cash or in T-bills?
Yeah, I think, having a high degree of just cash-like exposure could be T-bills. But I think the opportunity to buy lower is something that certainly could present itself. The second is just in terms of asset classes. If you are a long-only investor, that does have to be long risk. I think high yield is actually a better place to be than the equity market right now. Companies are hunkering down. They're building cash hoards.
Right.
And, the combination of, at least for now, low defaults and high spreads, I think makes high yield attractive to the growth prospects of equities.
Well, we had Jefferies out this morning basically say we want to demonstrate how liquid we are, that we can get out of some of these, sovereign debt purchases that we hold on to. So what does a person do to try to increase that liquidity? I mean, what cash level are you suggesting that an individual will take right now?
Well, again, it really depends. Our client base tends to be hedge funds, so they can be long, they can be short. There's obviously another segment of the market that has to be long. I'd say for the folks that have to be long, having cash levels really as kind of high as you can, I think is the sensible way to play it at this point.
And what about gold? What portion of the portfolio?
Yeah, so we think gold's got another day in the sun coming here. We've noticed over the last couple of weeks that as Bernanke has started to become more dovish, members of his team have become more dovish. I think gold's got a nice little base here. And our view at Macro Risk Advisors is really the only way out of this, at least for the time being, is a significant amount of further printing from both the ECB and the Fed. We think that's very conducive to higher gold prices.
And what form does that come in?
Well, we like GLD options. Again, we think that gold is something that's ramped up, a huge amount in the last couple of years, and it tends to be that in a financial crisis, people sell their winners first.
Right.
So gold is vulnerable to that. So we like using the call options as a way of getting the upside exposure, but at least being able to walk away from it if the bet goes wrong.
All right, Dean, thank you very much for joining us here on the floor of the exchange.